Your first paycheck can either build your future or destroy it. Because most people think saving money is enough, but inflation silently eats it away.
You did it. You landed the job, you're officially starting your career, and that very first real paycheck just landed in your bank account. I mean, what a feeling, right? But hold on. Before you even think about what to buy, we've got to talk about a plan for your future. A plan to make sure this money starts working for you. Let's get into it.
So you've got this new money sitting in a savings account, and it feels safe, doesn't it? Of course it does. It's insured, you can get to it whenever you want. But here's the question that almost nobody thinks to ask. Is that money actually safe just sitting there? The tough answer is no, not really.
And the reason why is a little something called inflation. You've heard of it, but what does it mean? Well, in the US, it averages around 3% a year. All that means is stuff gets more expensive. Your dollar just doesn't stretch as far as it used to. So, if your money in the bank isn't growing by at least 3% every single year, you're actually losing purchasing power. It's like a slow, silent leak in your financial bucket. So, how do we plug that leak? You know, the first instinct is to jump right in and chase those huge investment returns. But that's kind of like trying to build a skyscraper on a patch of sand. It's just not going to work. First things first, we have to build a rock-solid foundation. We got to build your financial armor. And this part, it's completely non-negotiable.
I want you to just look at this number for a second. 25%. That's the average interest rate on credit card debt. Think about that. That's not a potential gain. It's a guaranteed 25% loss every single year. It's a hole so massive that basically no investment on planet Earth can reliably beat it. This right here is the #1 enemy of your financial future.
And this is the perfect way to think about it. Trying to invest while you're carrying high-interest debt, it's exactly like pouring gas into a tank with a hole in the bottom. The money just pours right out, probably faster than you can even put it in. You're fighting a battle you're destined to lose. You have to patch that hole first.
Okay, so your financial armor is made of two critical pieces. Part 1. You have to attack and destroy any debt with an interest rate over, say, 10%, especially credit cards. Look at it this way. Paying off a credit card that's charging you 25% interest is the same thing as getting a guaranteed, tax-free 25% return on your money. You will never find a deal that good in the stock market. Part 2. Build an emergency fund. This is just cash set aside that covers 3 to 6 months of your absolute essential living expenses. It's your buffer, your safety net for when life, happens.
All right, your armor is on. That foundation is solid. Now you are ready to actually invest. And here's the secret. The best path, the one that builds real, long-term wealth, it isn't sexy. It's not exciting. In fact, it's wonderfully boring. And that's actually its superpower.
This is the biggest trap new investors fall into, chasing the hot stock of the day. It makes sense on the surface, right? A company's all over the news, everyone's talking about it, so it must be a great investment. Well, not so fast. Remember Nokia? They had like 40% of the entire cell phone market. Then, poof, their stock fell 90%. Or what about Cisco, a dot-com darling that took 26 years just to climb back to its peak price from the year 2000? The lesson here is crystal clear. Today's superstars are very rarely tomorrow.
So what's the alternative? Well, instead of putting all your eggs in one basket, betting everything on one single company, you just buy the entire basket. That's what an index fund is. It lets you own a tiny little slice of hundreds, sometimes thousands of companies all at once. So if one of them fails, it barely even makes a dent in your overall investment. This is diversification, and honestly, it's the closest thing to a free lunch you'll find.
And hey, don't just take my word for it. This is Warren Buffett, maybe the greatest investor of all time. He's been saying for decades that for most everyday people, the single best way to invest is to just buy a low-cost index fund and call it a day. If it's good enough for Buffett to recommend, it's definitely good enough for us.
Now, picking the right investment, that's really only half the battle. The other half, and this is the part where most people really stumble, has absolutely nothing to do with charts or numbers or company reports. It's all about winning the mental game. It's about managing your own emotions. Let me tell you a quick story. Imagine you have the worst luck ever. You invest $10,000 in a tech index fund right at the tippy top of the market in 2007. Then, boom, the 2008 financial crisis hits. By 2009, you look at your account and your $10,000 is now worth about $5,000. Your stomach drops. Every single instinct in your body is screaming at you, sell, get out before it goes to zero. But what if you just ignored that feeling? What if you did nothing? Well, by 2010, you were already back to even. And today,
that same $10,000 would be worth almost $96,000, all because you were patient. This really is the most important lesson in all of investing, so let it sink in. Trying to be a genius, jumping in and out, trying to predict the highs and lows, it's a game that almost no one wins. Real success comes from time in the market, just being there, riding out the storms, and letting your money slowly and steadily grow over years and decades. And if you're still not convinced, get this. Studies have shown that if you missed just the 10 best days in the stock market over a 20-year stretch, your total returns would have been cut in half. And the crazy part? The best days are impossible to predict. They often pop up right after the absolute worst days, so the only way to guarantee you catch those huge upswings is to just stay put through everything.
Okay, so we've covered the why, we've covered the how. Let's talk for just a second about the what. Now, to be super clear, this isn't personal financial advice. You've got to do your own homework. Think of this more like a starter kit. Just a few common examples to point you in the right direction for your research.
Let's look at 3 popular options. Each one has a ticker symbol, which is just its stock market nickname. First up, you have VTI. This fund basically owns a piece of the entire US stock market. It's the ultimate set-it-and-forget-it default choice. Then there's VUG. This one is focused on high-growth companies. It's a bit more of a bumpy ride, but the potential for higher returns makes it a good option for younger folks with decades to invest. And finally, SCHD. This fund holds stable, established companies that pay out cash to their shareholders, which are called dividends. It's really popular for people wanting to build up a stream of passive income.
So there you have it, the whole game plan. Build your armor, take the boring path with index funds, and win the mental game by just being patient. The strategy itself is pretty simple. The hardest part is just getting started. So I'm going to leave you with one last question to think about. Now that you know the path forward, what's the real cost of waiting? How much future wealth are you leaving on the table by putting this off for just one more year?
So the biggest mistake isn't spending too much, it's not making your money work. Subscribe if you want to turn income into long-term wealth.